This video looks at Chapter 17 examples for Principles of Accounting 2. So in Chapter 17, we talk about job costing. So all of these examples are going to look at job costing from the chapter. In this first example, we're going to look at journal entries that we need for recording job costing information for jobs. So we have information that we finished a job on June 1st, and then on June 10th, we sold that job. So we need to record the journal entries to finish that work in process project, and then the sale of the finished job. So our first entry is June 1st. And we're going to move that finished jobs to finished goods inventory so it is available for sale. And the cost of that job, it tells us, is $7,000. When we move jobs to finished goods inventory, we're moving them out of our work in process inventory. So the credit account is work in process inventory. The second transaction is to record the sale of that job. Remember, there are two journal entries anytime that we record a sale. The first one to record the sale, and the second one to remove our inventory to cost of goods sold. So first, we have a sale. We received $10,000 in cash, and we have sales revenue. Second is our cost of goods sold entry for the inventory. So the cost of that project, remember, was $7,000. We're going to remove it from the finished goods inventory. And those are the journal entries needed to finish a job and sell a job. The second example that we're going to look at is talking about different overhead allocation bases. So when we're allocating overhead, companies get to decide how they're going to allocate overhead. Now they should think about their processes, and they should choose the process that makes the most sense for their organization. So this company creates software programs, and they've looked at two different possibilities for allocating overhead. They can either use direct labor hours for the year or total estimated lines of code for the year. So what they want to know is, what is their predetermined overhead rate for the year under each base? To calculate the predetermined overhead rate, we take total overhead costs for the year, estimated overhead costs for the year, and divide it by the estimated base. So if we're looking at the base is direct labor hours, we're going to take the estimated cost of $360,000 and divide it by that 30,000 labor hours. We get a rate then of $12 per direct labor hour. The second option we have is by lines of code. So if we're going to use the lines of code as the allocation base, we would take our total estimated cost of $360,000 and divide that by 1 million lines of code. That gives us a rate of 36 cents per line of code. If we choose per direct labor hour, then throughout the year, when we have software jobs for clients, we would record our overhead at a rate of $12 per direct labor hour. So however many hours of labor that job takes, we take $12 times that amount to apply overhead. If instead we choose the lines of code, then we would calculate how many lines of code were in that software project, and we would take 36 cents times each line of code to apply overhead to that job. Our next example is going to look at journal entries related to overhead. We allocate overhead to jobs, and then we also record actual overhead costs throughout the year whenever we receive information about transactions that relate to overhead. Overhead is a temporary account that needs to be closed at the end of each period. So we either over-apply overhead, so we've overestimated for the year, or we under-applied overhead, so we estimated lower than our actual costs were. We record actual overhead costs on the debit side, and we record estimated overhead costs on the credit side. When we write off that account, when we close that account, we need to make sure that the account equals 0. If we have a debit balance, then we under-applied overhead, and if we have a credit balance, we over-applied or over-allocated overhead. So we have information about this business. We have a $25 per machine hour rate, and during this period, we used 800 machine hours. So we're going to apply overhead to jobs completed during that period. When we record inventory to jobs, we record everything to work in process inventory when we allocate to jobs. So when we bring materials into jobs, that is a debit to work in process inventory and a credit to our materials inventory. When we attribute direct labor to jobs, we put a debit to work in process inventory, and then our credit is going to be our labor payroll account. When we record overhead or allocate overhead to jobs, we're going to debit work in process inventory to add those costs to our jobs in process, and then we're going to credit overhead. So we have work in process inventory, and we're applying overhead at a rate of $25 per hour to 800 machine hours. We take 25 times 800, and that is $20,000. Our credit is to overhead for $20,000. We record our applied overhead of $20,000. Our second journal entry is to record the actual overhead costs. So our actual overhead costs for the period were $19,500. So we're going to debit overhead, because remember, we debit for actual costs and we credit for our applied or allocated costs. And then the credit would be various accounts. So it doesn't tell us what overhead we had for the year. So these could have been utilities expenses that we paid with cash, or payroll expenses that we paid with other things. So we're just going to record that it was attributed to various accounts. We debit for $19,500. So we have a difference of $500 in this account at the end of the period. Our credit side is higher, which means we over-applied or overestimated what our overhead cost was going to be compared to the actual overhead costs. So we're going to write off that amount to close the account. We need to debit overhead for $500 to make that account 0. So we're going to debit overhead for $500. Our credit is to cost of goods sold. So we write off that overhead amount at the end of the period to cost of goods sold when we're closing our accounts at the end of the month. Those are journal entries related to overhead. In this example, we look at an activity-based costing example. So activity-based costing is a method of costing that we can use within job costing. So activity-based costing is related to how we allocate overhead to jobs. We can use a single rate that we've looked at in other problems. So like the CompuLine example, we had a single rate that was either based on direct labor hours or based on lines of code. We can also have departmental rates where we charge one rate in Department B, one rate in Department A, one rate in Department C. And another way that we can do it is by activities. So we decide what activities we have as part of our production, and then we separate our overhead costs into those activity-based cost pools. So this company has identified 3 cost pools, and each cost pool has its own allocation base. Utilities is based on machine hours, maintenance by number of orders, and setup by number of production runs. As we calculate the overhead rate for each of these activities, we use the same formula for determining overhead. So we take the total estimated overhead costs divided by the allocation base. Machine hours, we have 180,000 machine hour, or total estimated dollars, divided by 8,000 total machine hours. That gives us an overhead rate of $22.50 per machine hour. For the number of orders, we take the 240,000 in estimated costs divided by 200 orders, giving us an allocated overhead of $1,200 per order for maintenance costs. For setup costs, we have 60,000 in total setup costs based on production runs. We take $60,000 divided by 100 production runs, giving us a rate of $60,000 per production run. The other way that we can allocate overhead in this example is by the percentage usage per product. So of our 8,000 total hours, 1,600 of them are used by basic, and 6,400 are used by the deluxe model. So 20% of the costs are used by basic, leaving 80% of the costs for the deluxe model. So we can allocate this 180,000 based on percentages or based on the overhead rate. We will get the same result. So if we take 180,000 times 80%, we're given a rate of $144,000. See, we give the remaining 20% to the basic. If instead we decide to do by the total machine hours and the overhead rate, for the deluxe we would take 6,400 times our $22.50. As you can see, we get the same exact result. So you can calculate it either way. So we're going to allocate the maintenance costs, $1,200 per order times 50 orders for the deluxe, and $1,200 per order times 150 orders to the basic model. And our setup costs, we have $600 per production run times 30 production runs for our deluxe model, and $600 per production run times 70 production runs for our basic model. If we add those up, we get our total overhead allocations per model. We've allocated $222,000 in costs to the deluxe model and $258,000 in costs to the basic model.